Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. This is Wednesday, the 14th of December. I am Daniel Lam, your host for the podcast. For those of you who've been following this podcast, you would recall how my most recent chess tournament was not going so well. As it turned out, in the final night of the same competition, which was 2 nights ago, I won all my games, and the 2 players ahead of me all stumbled. Thus, with a lot of luck, I managed to win my 7th National Rapid Chess title. I do cherish this because competition is getting tougher, with so many up-and-coming, strong, young players. Now, in the investment world, are we finally getting some luck? Is inflation slowing down? Well, overnight, the US November CPI inflation figure slowed down for a second consecutive month. The headline figure eased to 0.1% month-on-month increase, which is equivalent to 7.1% year-on-year, falling below consensus estimate. Core inflation was also softer than anticipated, moderating to 0.2% month-on-month, down from 0.3% month-on-month, and the equivalent year-on-year figure was 6% versus 6.3% last month. That was the smallest monthly increase in over 1 year. Price pressures seem to be easing in a broad-based fashion across all the main contributors, such as energy prices, vehicle prices, airfares, and medical care services. Now, the 2 key areas that economists have been looking at, i.e. shelter and core services, also saw price moderation, with shelter up 0.6% month-on-month, down from 0.8% month-on-month, and core services at 0.4% month-on-month, from 0.5% month-on-month. So now, does this mean that there will be a pause in Fed rate hikes in the first half of next year? Well, it could be a bit too early to make this call, given that labor market dynamics still remain very hot. A clear moderation in wage growth is likely to be a prerequisite for ex-housing core services inflation to ease. So this explains why the key US equity indices, such as S&P 500 and NASDAQ 100, started very strongly at the open last night, but ultimately turned weaker through the trading session. This phenomena was what we talked about in our podcast this Monday. We said investors should consider rotating into higher quality income assets should S&P 500 gets to 4,100 post-CPI or FOMC. Well, S&P 500 did open at the highs and went just to 4,101, but ultimately ended near day lows. The rotation into high-quality income assets remain our key recommendation to investors. They should also look to extend duration in their portfolio, as longer-dated yields may be kept due to the potential looming recession. We do believe U.S. government 10-year yield may go to 3.25% in the year of 2023. That is all from me for today. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.